Welcome to the Deep Dive, where we take a monumental stack of sources, articles, research papers, financial models, and white papers, and distill it down to the crucial, memorable knowledge you need to be truly informed. Today, we are wading into the deep end of one of the most polarized, fiercely debated topics in the entire global market, Tesla.
It's a minefield.
It really is. Our listener, The Learner, shared a fascinating set of sources that illustrate a company where, professional analysts and fund managers have price targets ranging from an astonishing extreme bear estimate of $19.
19. It's just incredible.
All the way up to an extreme bull target of $600 or even more. That is a chasm of disagreement that you just don't see for most publicly traded companies.
No, not for a company of this size.
Yeah.
It's almost unheard of.
And this level of polarization, that's the key. It means this isn't just a simple disagreement about, say, quarterly revenue or how fast the company grows next year. It's a deep, fundamental identity crisis.
That's the perfect way to put it.
So, our mission today is to dissect the competing identities proposed in your sources. Is Tesla a legacy-style automotive manufacturer? Or is it a pioneering tech and artificial intelligence giant, a physical AI platform?
And we need to give you the framework to analyze it.
Exactly. We need to provide the disciplined framework required to analyze this high-stakes, probabilistic bet. The core of the entire debate, therefore, boils down to classification. Where do we file this company? Okay, let's unpack this.
That classification challenge is the single most important variable. It defines this company's massive and, let's be honest, often volatile market capitalization. You have to start with the baseline comparison.
Right.
If you look at Tesla strictly through the lens of a car company, meaning you judge it based on the high capital intensity and the notoriously low margins of the traditional auto industry, its current price-to-earnings ratio.
The PE ratio.
Yes, which frequently swings between 50 and 80 times earnings. That is absolutely, completely unsustainable.
And just to put that into perspective for everyone, what would a normal car company's PE look like?
Well, you look at a highly efficient, established global manufacturer like Toyota, its PE ratio typically trades in the single digits. We're talking, between 5 and 8 times earnings.
5 to 8 versus 50 to 80.
It's a different universe. A 50 times multiple suggests the market expects decades of explosive growth and revolutionary margin expansion. A traditional automaker just cannot deliver that. It's not in the business model.
So on the flip side, if we accept the bullish premise that Tesla is, or will soon become, a scalable AI and robotics platform, the term we've seen everywhere in the sources is physical AI, then
the current massive price, while it looks intimidating, actually reflects only a relatively small probability of its eventual colossal success.
So you're saying it's pricing in hope, not certainty.
Precisely. The volatility and the vast range in price targets from 19 to 600, that tells you that the market is struggling to assign a consistent probability. Everything hinges on whether Tesla's futuristic bets on autonomous driving and robotics actually pay off.
And deliver that massive technological paradigm shift the bulls predict.
Right. If they fail, or if the technology is just too late, the company converges back to being just another automotive manufacturer, and that 50x PE multiple, it collapses overnight.
That's the tension. That's what we're diving into.
That's the whole game right there.
Okay, let's define the trenches in this valuation war. We have two incredibly distinct camps, and it seems like the time horizon they operate on is what really separates them.
100%.
On one side, we have the bulls, the believers. These are the evangelists for the platform thesis. Key proponents mentioned in the sources include Dan Ives from Wedbush. He's known for his aggressive optimism in tech.
And of course, Cathie Wood from ARK Invest. Her entire fund strategy is often built around this company's potential.
And their narrative is, by design, completely divorced from what's happening today, right?
It has to be. They argue that the autonomous driving feature, full self-driving or FSD, the hardware platform Dojo, and the robotics platform, Optimus, that these things collectively represent fully 90% of the company's long-term value story.
90%.
So they look right past the current financial statements, which show margin pressure and slowing vehicle delivery growth, and they focus squarely on the long-term, extremely high-margin software revenue streams these technologies could unlock.
So they're essentially asking you to ignore the car business.
Or rather, to see it as merely the necessary low-margin shell that houses the real prize, the AI platform.
Okay, then on the other side, we have the bears, the non-believers who demand proof now. We see figures like hedge fund manager Per Lakander.
He's known for short positions.
And firms like GLJ Research, which has historically maintained that extremely low $19 price target, their view is blunt. Tesla is just an overvalued car company right now.
That's it, full stop. They argue that the company is facing severe fundamental business problems. Things like demand saturation, the rising costs of scaling production, and, most painfully, falling operating margins.
And all of that is just being
So
obscured.
obscured by persistent, noisy AI hype that never seems to deliver on its timeline. That's the core of the bear case.
This philosophical disagreement about the business timeline, it really is what makes the analysis so difficult. As one of our sources put it, the bulls are applying a complex, discounted cash flow model to cash flows they expect in the year 2030 and beyond.
While the bears are performing a harsh audit of the company's 2024 financials.
That's such a powerful distinction.
It is because it dictates what metrics you can care about. The bulls are focused on total addressable market, or TAM. They talk about a multi-trillion-dollar market for autonomous labor and transportation.
Trillion with a T.
Exactly. The bears couldn't care less about TAM. They are focused on shrinking current profitability, rising inventory levels, and increasing global competition today.
So to really illustrate this fundamental divide for you, the listener, we have to look at the battleground metrics, specifically how the two sides choose their comparable companies. This is where valuation really starts.
It's the first decision you make.
So if you are a bull, you're comparing Tesla to tech giants like Apple or Nvidia or even Google, companies known for creating platform ecosystems with negligible marginal costs and exponential scaling through software.
Right, they command those high PE multiples because they are perceived as monopolies or near monopolies in their ecosystems. Think the App Store.
But if you're a bear,
If you're a bear, you compare Tesla to high-volume automotive manufacturers, Toyota, Volkswagen, maybe Ford. And when you use those comparisons, the valuation multiple just collapses immediately.
because those companies are valued on completely different metrics.
Industrial, cyclical, capital-intensive metrics. And this choice, it drastically affects what you expect for margins.
How so?
Well, if Tesla is a software platform, the bulls anticipate achieving gross margins of, say, 20 to 30% on the vehicles themselves.
Which is already high for the auto industry.
Very high. But crucially, once the FSE subscription rolls out at scale, they expect SaaS-like margins on that revenue stream. We are talking potentially 70 or 80% gross margins on pure software.
Okay, but the bears see those lofty predictions being crushed by reality. They point to the aggressive price wars initiated by Tesla itself.
Which they argue is necessary due to softening demand, not a position of strength.
And they expect severe margin compression, arguing that intensifying global competition, especially from efficient Chinese EV makers like BYD, will push Tesla's margins rapidly down toward that traditional 8 to 10% range.
And if those software margins never show up, that entire platform thesis just collapses into an 8% gross margin auto company. The premium is gone.
And this leaks directly to the differing valuation methodologies.
Exactly. The bulls rely heavily on that discounted cash flow model, the DCF. For those who aren't familiar, a DCF model estimates the future cash flows of a company, in this case, reaching way out to 2030 or 2035.
And then you pull those numbers back to what they're worth today.
You discount them back to their present value. And the further out you project that success, the more heavily weighted those huge future software profits are, which justifies a massive current stock price.
But the bears just reject this future gazing entirely.
Completely. They prefer using comparable multiples. They say, if Tesla is an automaker, let's apply the automaker PE multiple. They'll apply a low PE ratio, maybe 5 to 10 times, to current earnings, ignoring all the speculative future stuff.
Which naturally results in those extremely low price targets.
Of course, the valuation is grounded in current terrestrial reality, not speculative sci-fi.
And this polarization we're talking about, it isn't just online commentary, it's reflected in the institutional analysis. Your sources highlight that Wall Street analysts are split almost perfectly.
It's remarkable. 11 buy ratings, 12 hold ratings, and 9 sell ratings. A truly split decision like that is almost unheard of for a company of this size.
It's incredible. The average analyst price target is around $378, but this target often sits just, slightly below or slightly above recent trading levels.
Which suggests that even the hold camp, the market consensus, is deeply skeptical of the current valuation premium.
It's an entity with a market cap that can touch $1 trillion, yet the world can't agree if it's the next Nvidia or just an overpriced Toyota.
And the success of those futuristic bets is the ultimate economic driver here. It all comes down to that.
All right, let's leave the harsh reality of 2024 margins behind for a moment and step fully into the bull's corner. We need to explore the specific, detailed vision that justifies those multi-trillion-dollar valuations.
This is where the story gets really compelling.
The narrative centers entirely on the creation of a physical AI platform built on three primary and interconnected pillars.
Right.
Pillar one is the most immediate and maybe the most complex: full self-driving FSD and the robotaxi monopoly. This is the foundational trillion-dollar thesis.
It has to be.
The bulls see FSD not as a cruise control feature or a driver assist. They see it as the single foundational platform shift that redefines global transportation.
It's about making transportation autonomous,
Mhm.
available everywhere, and exponentially cheaper than any human-driven service.
And the economic outcome of this platform shift is what really matters.
Absolutely. If you solve FSD, the business model shifts entirely. You go from selling a depreciating asset, the car, to selling recurring high-margin transportation as a service, or TaaS. The car becomes a revenue-generating asset that works 24/7, not a liability sitting idle in a driveway.
And the bullish analysts, they get very specific about the revenue potential.
They do. They suggest FSD could generate high-margin software revenue in the range of $5,000 to $10,000 per year per vehicle.
Per vehicle.
Per vehicle, through subscriptions, ride-sharing revenue, or other services. If you compound that across a fleet of millions of vehicles, the total available revenue is astronomical, and the marginal cost of delivering that service is near zero.
And if that success is proven, the bulls believe this could drive the company toward a $2 trillion valuation in a remarkably short time frame.
They're talking 12 to 18 months post-full autonomy. The goal is to pivot completely from low-margin manufacturing to that guaranteed high-margin recurring software revenue with those 70 or 80% SaaS-like margins.
Okay, but wait, let me pause you there. We just spent all that time talking about the current margin compression, those operating margins plunging from 16% down to 8.2%. Why should you, the listener, believe in 70% software margins when the company can't hold 20% on the hardware that enables it? Isn't that a huge disconnect?
That's a brilliant question, and it highlights the absolute core of the bet.
Mhm.
The bulls argue that the current margin pressure on the hardware is, well, it's irrelevant noise,
Noise.
or even a necessary sacrifice to rapidly increase the size of the fleet. They're trying to build the largest possible install base of physical AI, endpoints the cars.
So it's a land grab.
It's a land grab, because the recurring revenue stream generated by that fleet will eventually dwarf the one-time revenue from selling the car itself. They're willing to lose margin on the razor to secure the profits on the blade. It's a classic platform strategy, just applied to a very big physical product.
That makes sense. That brings us to Pillar 2, which feels almost like a speculative bonus. Optimus and general robotics. This is where the long-term vision truly starts to feel like science fiction.
But the numbers analysts assign to it are colossal. Musk himself has suggested that the Optimus humanoid robot could eventually surpass the automotive revenue entirely.
And the theoretical market size he talks about is
Global human labor replacement. It's estimated to be a $20 trillion+ market. Even if you capture a tiny fraction of that, you get truly mind-boggling numbers. Some bullish analysts assign an optional long-term upside exceeding $10 trillion in value just to the robotics division.
a trillion.
Now, to be clear, most disciplined analysts don't price this in fully. They treat the Optimus vertical as an out-of-the-money call option, meaning its potential is so vast that it doesn't need to be realized to justify the current stock price. But it represents massive, non-linear optionality. The argument is simple. If the FSD AI brain works, if it can navigate the real world, understand physics, and process visual data, then the Optimus brain is 80% of the way there.
So it provides this exponential, almost unquantifiable upside that the skeptics just ignore.
They have to. It's too speculative for their models.
And Pillar 3 is the grounding force, the segment that actually has high measurable growth today, energy and the manufacturing moat.
This is the part of the business that's already firing on all cylinders.
We're talking about the Tesla Energy division, the Powerwall for home storage, and the massive utility-scale battery solutions, the Megapack. Your sources show this segment isn't just growing, it's growing at an incredibly rapid clip.
Often exceeding 50% year over year. The bulls believe this segment, leveraging Tesla's vertical integration and battery expertise, could eventually match or even exceed the automotive revenue.
Positioning them as a utility-scale energy provider.
It's exactly. Feeding off the global transition to renewables and, interestingly, the increasing power demands of all these new AI data centers.
And this structural advantage extends to manufacturing itself. Critics of the auto thesis often overlook the innovations designed to protect margins.
They do. Techniques like gigacasting, where massive sections of the vehicle chassis are cast as a single piece, and the streamlined unboxed process are all designed to eliminate complexity and waste. The stated goal is to make Tesla the absolute lowest cost producer in the world.
And this structural cost advantage is what's intended to provide protection against that margin compression we talked about.
It's what allows them to aggressively cut prices in a price war and still maintain stronger margins than legacy competitors. This is reflected in their financials today, with strong free cash flow growth and a quick ratio of 1.55.
Which suggests they have significantly better liquidity and operational efficiency than traditional automakers weighed down by fragmented supply chains and legacy tooling.
It's a real measurable advantage.
So to tie all these pillars together, FSD, Optimus, and the manufacturing moat, the bulls use what we're calling the moment framework. This is the intellectual scaffolding that explains why they believe this future success is inevitable, not just possible.
Right. The framework suggests that true massive technological transformations, the kind that create trillion-dollar companies, they all follow a predictable anatomy. Think of the internet in 1995, the iPhone in 2007, or the recent NVIDIA AI explosion starting around 2022.
And the first component is the accessibility breakthrough. This is the moment the technology becomes cheap or easy or user-friendly enough for the masses. The iPhone took the complex mobile internet and put it into everyone's pocket for a reasonable price.
ChatGPT took complex AI and made it available through a simple chat interface.
And the bulls see FSD as that threshold for transportation, making autonomous, cheap transport universally accessible.
Then, after that breakthrough, you get exponential adoption. These moments aren't linear. They're hockey stick curves. ChatGPT hit 100 million users in 2 months. Unprecedented speed. The iPhone created an ecosystem now worth trillions.
So the bulls project that once FSD achieves that level 4 reliability, adoption will be explosive following this non-linear curve.
Yeah, and finally, that leads to platform creation. The technology moves beyond being just a product and becomes the foundation for new economic activity.
Like the iOS Android ecosystem for mobile.
Exactly. Bulls see FSD and Optimus creating a new platform for transportation and labor, leading to winner-take-most dynamics where one or two platforms, maybe Tesla and Waymo, dominate globally.
It's an incredibly compelling historical analogy. But we need to pause and look at the difference between those historic moments.
This is a critical distinction.
Compare the iPhone moment to the Tesla moment. The iPhone was characterized by immediate, undeniable utility. You touched it, and its superiority to a BlackBerry keyboard was obvious and functional on day one.
The breakthrough was immediately accessible and reliable.
And now look at the NVIDIA AI moment. That involved an invisible product, the chips, where the ultimate societal utility is still being proven. We are betting trillions on AI infrastructure, but the full payoff, the moment where productivity explodes, is still future tense.
Right. And the key difference for Tesla is that it sits somewhere in the middle, but it's leaning heavily toward that future tense bet. The iPhone worked immediately. Tesla's moment depends entirely on technology, FSD, that, despite years of development, still doesn't fully work unsupervised for the general public today.
So the believers are placing an aggressive, highly time-sensitive bet on an imminent future breakthrough.
While the skeptics look at the 8 years of delays and simply dismiss the entire premise as vapor.
That skepticism is the perfect bridge to the bear case. We have to pivot now from that future vision to a harsh audit of the current deteriorating fundamentals.
Back to 2024.
Back to reality. If you strip away every ounce of AI hype, the critics argue that Tesla is facing two primary painful truths right now that are killing the narrative of exponential growth.
And they have the data to back it up.
First, they face undeniable demand saturation and margin compression. The critics contend that the evidence is overwhelming that Tesla faces a demand problem, not a supply issue. The most painful piece of evidence is the aggressive, repeated global price cuts on their core models.
Those cuts, they argue, are necessary tactics used to move the metal and empty inventory, not strategic moves from a position of pricing power.
Furthermore, the vehicle lineup has aged. The Model 3 and Model Y, while excellent cars, make up the bulk of sales, and there have been no genuinely significant mass-market new vehicle releases.
Like a smaller compact car, for example.
Right. Nothing like that is expected until 2025. This stagnation means they are relying on ever deeper discounts to maintain unit volume, which is exactly the opposite of a high-growth platform company.
And the margin data points are stark. The aggressive price cuts have caused gross margins in the auto segment to drop precipitously from a high of, what, 23.8%?
Down to 17.6%.
And operating margins, the true measure of a company's fundamental profitability, followed suit. They fell from a high of 16% to a mere 8.2%.
The skeptics see this as irrefutable proof that Tesla is rapidly converging toward legacy auto margins, negating the entire software premium valuation premise.
And the convergence is being accelerated by the competition. The early mover advantage that Tesla enjoyed for a decade has severely eroded.
In massive markets, especially in Asia, cheaper, highly efficient Chinese EVs, led by BYD, are aggressively eating away at Tesla's market share.
And moreover, in the lucrative luxury segment, legacy brands like BMW, Mercedes, and Audi are offering electric alternatives that many critics argue offer superior interior build quality and comfort areas where Tesla has historically struggled.
So on top of the financial fundamentals, the bear case rests heavily on technical risks, specifically FSD skepticism and governance risk.
FSD is frequently called vaporware, and you can see why. Musk has famously promised full autonomy is 2 years away, for almost a decade now.
That long history of missed deadlines creates a credibility gap.
A huge one. And that skepticism is why former high-profile bulls, like the asset manager Ross Gerber, publicly sold their positions, stating they believe simply that FSD doesn't work yet. And if it doesn't work, that completely hollows out the multi-trillion-dollar growth narrative.
And the associated governance risk is critical for any long-term investor. Tesla is so inextricably linked to Elon Musk.
And his intense focus on X, formerly Twitter, his new AI venture XAI, and his increasingly polarizing political activities create severe key person and brand risk.
Critics argue that this polarization is actively alienating the core, progressive, environmentally conscious demographic that traditionally drove EV adoption.
Which could further dampen demand in their most loyal markets.
This brings us back to the technological heart of the debate, because the bulls have a powerful rebuttal to FSD skepticism rooted in the idea of scale. They introduce this powerful metaphor of the BlackBerry trap.
This is a really important concept to grasp.
The skeptics look at Waymo Google's autonomous driving subsidiary, which uses LiDAR, radar, and highly detailed HD maps. And Waymo works unsupervised today in geofenced cities like Phoenix and San Francisco.
So they conclude Tesla is losing because its vision-only system still requires supervision.
But the bulls argue Waymo is the BlackBerry of autonomy.
It works perfectly, but only within narrow, geofenced constraints. It relies on expensive, custom hardware and pre-mapped hard-coded rules for specific cities. It cannot scale efficiently.
So every new city requires new mapping, new infrastructure, new rules.
It's a linear, capital-intensive system.
Right.
They argue Tesla's the iPhone. It relies on generalized, adaptable, software-based intelligence neural networks and pure vision. It might be slightly worse in the short term, but it scales infinitely once the general intelligence problem is solved. The hardware is cheap, and the software is universal.
And here's the convincing data point for the bulls' scale.
This is their trump card.
Waymo has maybe 2,500 cars in its fleet. Tesla has an active fleet of approximately 6 million cars generating driving data every day. 6 million.
If the solution to general autonomy is simply overwhelming data volume, seeing every possible corner case driving scenario, then the bears are fundamentally missing the point.
Exactly. The bulls argue that Tesla is brute forcing the solution to general vision using a massive distributed supercomputer, the cars themselves, that the bears mistakenly classify as merely depreciating automobiles.
To evaluate this core architectural claim, the physical AI thesis, we must now dedicate a significant amount of time to the technical deep dive.
Right. The entire bullish thesis rests on the architectural shifts seen in FSD versions 12 and 14.
And the initial breakthrough was the shift to what's called pixels to control, end-to-end neural nets.
This validated the idea that the task of predicting where to move a car in a video stream can be treated like a language problem. Critically, this involved deleting approximately 300,000 lines of heuristic C++ code.
So the tedious handwritten if-then rules that programmers traditionally use to tell a car how to behave.
Let's make sure we unpack that jargon for the listener. What does it mean that motion solves like language? How does that connect to what we know about large language models like GPT?
It's the perfect analogy. Think about how a large language model works. When you prompt GPT, it doesn't look up a rule book on grammar. It predicts the most statistically probable next word in a sequence. It's a next token predictor.
Hmm.
When FSD operates in pixels to control mode, it's doing the same thing but in the physical world. It's ingesting a massive stream of visual data, the pixels, and predicting the most statistically probable next movement, the control, that a good human driver would make. That's why it's sometimes called a next video token predictor.
That makes the shift from hard-coded C++ rules to probabilistic prediction much clearer. It's a massive leap of faith in the power of scale and data over explicit programming.
It is. And the sources suggest that FSD v14 is the application of scaling laws to this principle. Just as GPT-4 got smarter simply by having more parameters and ingesting more text, v14 reportedly uses a vastly larger parameter count to ingest more video data.
And this process is revealing evidence of building a world model. And why is that world model so critical to the trillion-dollar thesis?
Because it's the bridge from FSD to Optimus. For the Optimus humanoid robot to manipulate the real world, it can't just memorize what a cup looks like. It has to understand object permanence, gravity, Newtonian physics. It needs a world model.
And the evidence for this is?
The evidence cited by Bowles is FSD v14 showing complex emergent behaviors that were never explicitly programmed in.
For example,
Complex acts like yielding naturally to merging traffic, understanding the subtle body language of pedestrians, or reacting correctly to human hand gestures from another driver. This implies the system isn't simply memorizing rules, but is actually building an internal predictive model. If I move here, that object will move there in 3 seconds.
a world model that accurately predicts car physics is 80% of the way to a world model that accurately predicts general object physics for a humanoid robot.
That's the argument. The AI brain is transferable, which validates the Optimus upside.
That is extremely fascinating, but we have to return to the damning technical critique that flips this analogy on its head. The inverted analogy.
This is the core of the technical bear case.
We agreed that the iPhone won because it worked better immediately. Waymo currently works, unsupervised, in major complex cities. Tesla's system still requires constant human supervision.
So the choice to go vision only was a massive cost saver for Tesla, saving an estimated $1,500 per car by removing LiDAR and complex mapping systems.
But the question remains, is that cost-cutting measure fundamentally insufficient from a safety perspective?
That's the billion-dollar question. Every serious competitor, Waymo, Cruise, even Mercedes, which achieved Level 3 conditional autonomy approval, uses LiDAR or radar for redundancy. They rely on it because cameras struggle in fundamental physics-based scenarios: heavy fog, complete darkness, torrential rain, or aggressive sun glare.
And if the vision-only approach fails reliably in that small 5% of physical scenarios?
Then the cheaper approach is revealed to be a fatal design flaw. You cannot scale a service globally if it fails in 5% of weather conditions or 1% of lighting conditions. The skeptics argue that Waymo's heavy approach, while expensive, is necessary to solve the reliability problem first, making them the real iPhone that works on day one.
Okay, we've established the soaring potential of the AI platform and the crushing reality of the current auto business. Now we must dive into the structural weaknesses and fatal flaws that prevent the bull case from being a guaranteed victory, regardless of how smart the AI gets.
These are the make-or-break issues.
We've identified 4 critical, technical, and business weaknesses that fundamentally undermine the high-margin platform narrative. The first is perhaps the biggest near-term economic threat. Flaw 1, the hardware wall.
This technical constraint is catastrophic to the sleeping robo-taxis thesis. Your sources report that FSD v14 requires newer, vastly more powerful inference hardware.
To the computer inside the car.
Right, specifically HW4 or the anticipated HW5 chip to run optimally and safely. Crucially, it runs poorly, or is fundamentally limited, on the millions of older cars sold between 2018 and now the HW3 fleet, which represents over 60% of the entire existing install base.
So wait, you're telling me the general-purpose brain is too complex and heavy for the older bodies, the existing cars? What is the economic impact of that?
The impact is profound. Because those millions of HW3 cars are not sleeping robotaxis waiting to be activated by a software update. They are, as the bears argue, just depreciating cars. The high-margin business model of selling software to an installed base of high-value hardware just vanishes.
Instead of remaining a high-margin software company, Tesla is forced to transform into a capital-intensive hardware refresh company.
Think about Apple forcing customers to buy new iPhones every 2 to 3 years just to run the latest OS, Only this is for a $50,000 car. It introduces massive obsolescence risk,
Yeah.
continuous capital expenditure, high customer acquisition costs, and it risks severe legal trouble.
Legal trouble stemming from those customers who paid upfront for FSD years ago based on the promise that their hardware was future-proof.
Exactly. Those customers effectively purchased an option on a future capability. If the company now tells them your existing hardware can't handle the final product, you must pay $1,500 for a new computer chip and labor. That represents a potential breach of promise.
And it opens the door to costly, large-scale class action lawsuits for undelivered FSD capability. This flaw radically changes the unit economics from software heaven to hardware hell.
A huge problem.
Moving on, we tackle flaw 2, the long tail problem. We talked about the architectural bet on probabilistic neural nets achieving high accuracy, say 99.9%. But in autonomy, that remaining 0.1% failure rate is a fatal crash.
The skepticism here is immense, and it rests on complexity. Is it technologically proven that a pure neural net, without those 300,000 lines of deleted, hard-coded logical safety nets, can achieve the required 99.99999% reliability needed for level 45 unsupervised driving?
That remaining 1% of scenarios, that's the long tail.
Right. It involves rare, unpredictable edge cases. The horse carriage on a modern highway, a construction worker holding a stop sign upside down, or debris flying off a truck. The problem is that the data required to train away these specific, rare failure modes might be so vast that it's simply impossible to train away all of them without structural logical safety nets.
Which the new architecture actively eliminated.
Exactly. The bulls bet that scaling laws solve this. The bears bet that reality requires redundant logic.
Okay, flaw 3 focuses on unit economics and the can opener fallacy. The bull projection of achieving robotaxi operation costs in the range of 20 to 30 cents per mile is the foundation of the profit thesis. But critics argue this projection contains a massive, critical intellectual flaw.
It's circular logic. The bull argument assumes the technological problem is solved and then calculates the subsequent profit, ignoring all the costs associated with solving the problem and operating the solution. That's the can opener fallacy. Assume you have the can opener before you factor in the cost of opening the can.
So let's inject some realistic, ignored variables. What happens to the economics when we factor in costs that crush those projected sauce margins?
Liability insurance is the single largest ignored cost. If Tesla wants to run a robotaxi fleet, it has to assume manufacturer liability for autonomous operation. And liability insurance for commercial autonomous fleets is astronomical. Realistic estimates put this cost between 50 cents to $1 per mile alone.
Which instantly swallows the entire projected profit margin.
Gone. Then you factor in real-world operational costs. Fleet maintenance, cleaning the cars, charging unexpected repairs isn't free. Depreciation is massive. A $40,000 car, depreciated over its robotaxi life, costs around 8 cents per mile alone. And finally, regulatory compliance, the permits, the city-by-city sign-offs, the safety monitoring staff.
The reality check, according to the sources, is brutal. The total minimum cost of operation is likely closer to 50 cents per mile, not 20.
And while this is still cheaper than Waymo's heavy hardware approach, which is estimated at $1.20 to $1.50 per mile, the massive margin advantage that justifies the trillion-dollar valuation disappears entirely.
If the costs are this high, the service price will be competitive, say 75 cents a mile, and fast followers like Uber and Legacy Auto will enter the market with competing rates, destroying the guaranteed monopoly-like rents.
Absolutely. Finally, we address flaw 4, the mispriced call option math. The bull case relies heavily on the asymmetric risk-reward calculation. Small downside, massive upside. The critique here argues that the risk-adjusted numbers used for both the failure and success cases are wildly inflated.
So let's look at the failure scenario. If Tesla fails to solve autonomy, the bears argue it is not worth the rhetorical $40 per share floor often cited by bulls.
It's worth significantly less. Realistically, $15 to $25 per share because of 3 factors: brand damage from broken promises, massive global competition eroding the remaining auto margin, and the costs of potential regulatory entanglement.
Conversely, the success case is overstated at projections of $3,000+ per share.
Even if autonomy works perfectly, the global market is not going to allow a true monopoly. Waymo, Baidu, and Mercedes will be fast followers, regulators will demand fair competition, and the price per mile will drop due to that competition. A more realistic, high-end success case is $800 to $1,200 per share.
And when you recalculate the expected value using those more disciplined numbers, a $20 failure floor and a $1,000 success ceiling, the current stock price implies the market is pricing in a 40% or greater probability of achieving transformative success within a defined timeline.
This is far from a cheap, speculative bet. It is a highly speculative, high-probability outcome that is baked directly into the current valuation.
So what does this all mean for the decision maker?
It means we have to shift from ideology, from being a believer or a non-believer, to a disciplined analytical approach. The disciplined framework views this investment not as a simple stock purchase, but as a multi-gate probabilistic bet, a venture capital-style decision on the future of AI applied to the physical world.
And for the exponential upside to materialize, the company has to successfully navigate 4 non-independent stages.
This is the four-gating model that you, the learner, must track constantly. Let's detail these crucial stages.
Okay, Gate A.
Gate A is technical autonomy. Can the end-to-end neural net achieve those superhuman failure rates required for open-world, unsupervised operation? This is the core engineering and data science challenge. Without solving this, nothing else matters.
Gate B is deployability. Can solved autonomy run efficiently and reliably on the existing fragmented fleet of HW3 and HW4 cars? This is the most pressing material risk. If the answer is no, the cost of rolling out a robotaxi fleet shifts from a software distribution, which is cheap, to massive capital expenditure on hardware refreshes, which is expensive.
Gate C is liability and regulation. Can Tesla operate at scale with an acceptable insurance at legal cost model? This is the most underrated bottleneck. Regulatory approval isn't granted globally. It involves city-by-city, state-by-state sign-offs and safety standard adherence that move infinitely slower than technology. This can stall deployment for years even after the tech is solved.
And finally, Gate D is competitive equilibrium. If all the technical and regulatory hurdles are cleared, will fast followers, global subsidies, and the inevitable price competition allow monopoly-like profits to persist?
Or will the robotaxi business quickly become a commoditized, low-margin service similar to current ride-sharing models?
Of these 4 gates, you're saying the single most critical variable governing the final valuation is timing.
It's not a footnote, it is the entire thesis. A solution to global autonomy delivered in, say, 2026 implies a wide moat, high initial pricing power, and a high present value for those future cash flows. That justifies massive upside.
But a solution delivered in 2033?
By which time Waymo, Baidu, and a host of Chinese competitors will have likely achieved level 45, that causes the present value to collapse. Why? Because capital competition and technological diffusion erase late victories. The upside premium is entirely dependent on whether Tesla solves and scales the solution quickly, establishing that critical winner-take-most lead.
This has been a true deep dive into one of the most complex, contentious, and rewarding investment theses of the entire decade. We've thoroughly explored the massive divergence in valuation metrics legacy auto multiples versus the AI platform premium.
The audacious technical bet on end-to-end AI scaling using massive data.
And the structural risks posed by the critical hardware wall, the long tail problem, and high regulatory and liability barriers.
A lot to consider.
The rational position, we conclude, is to model Tesla not as a traditional stock, but as a compounded option on deployable autonomy. It requires treating it as a venture capital-style risk that just happens to exist in a public equity portfolio.
The upside is massive, multi-trillion-dollar potential, but the failure modes are multifaceted, deep, and tied to physics, regulation, and hardware reality.
The final takeaway for you, the learner, is this. The investment decision hinges entirely on your personal assessment of the probability and the timeline associated with those 4 gates.
You have to make your own call.
If your estimate for deployable, insured, and scaled autonomy by, say, 2029 is high, perhaps greater than 50%, you lean strongly bull. If you believe the hardware wall, liability costs, or the long tail problem reduce that probability below 40% in that time frame, you must lean bear. Your personal probability assessment determines the correct price target.
And this leaves us with the final provocative thought. The core question separating believers and non-believers is not about vehicle quality or brand loyalty. It is a fundamental technological argument about the future of physical AI architecture.
Is the solution to global transportation and labor replacement going to be solved by adding sensors, redundancy, and explicit safety rules, the Waymo approach?
Or will the solution be solved by adding scale, massive data, and pure adaptable vision-based neural networks, the unique Tesla approach? Which technological path wins the next decade of physical AI will dictate the winner of the trillion-dollar prize.